Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now to this episode's lecture. MidYear Acquisition. So up until this point, all we have discussed have had the acquisitions made at the inception of the accounting period. Therefore, the entire profits for the year of the subsidiary stands to be attributed to the parent, that is the post-acquisition reserves or profit. Now, in this episode, we will be discussing the situation where a parent acquires controlling shares or interest in a subsidiary at a time that the accounting period is already in session. Now, this will only impact the post-acquisition reserve, that is the subsidiary's retained earnings to be distributed to the parent and in certain instances together with the non-controlling interest. Let's take a look at the steps involved. First, one must assume that the profit of the subsidiary accrues evenly throughout the year, meaning the same amount of profit is to be attributed to the months of the accounting period. So one simply has to divide the profits for the year of the subsidiary by 12. Then we prorate based on the period that a parent-subsidiary relationship transpired to arrive at the post-acquisition profit. Let's test our understanding. Now, Raymond acquired 75% of Anita's ordinary shares on 1st June 2020. Their year end is 31st December 2020. So Anita's retained earnings at the end of the year were $720,000 and its profit for the year was $240,000. So when we come to the solution, the profit for the year, as stated in the question, is $240,000. So the monthly profit will be $20,000 because we are supposed to assume that the $240,000 accrued evenly throughout the year. Okay, so the post-acquisition profit will be $140,000, which is the 7 months that the parent has been engaged with the subsidiary. From 1st June to 31st December is 7 months. So you multiply by the monthly profit. Alternatively, we can use a shorter method of striking the 7 months existence with the subsidiary by the total number of months, which is 12, by the $240,000. Let's test our understanding again. Janet Limited purchased 90% of the equity capital of Lily Co. for $2 million on 1st February 2017. So the following statement of financial position for the two companies have been prepared at 31st December 2017. So we have the account for Janet and that of Lily. So the concern here will be the retained earnings of Lily. So when we come to the solution, Lily's profit for the year will be $600,000. Then the monthly profit will be $50,000. As said earlier, we divide the profit by 12. Janet had been with Lily for 11 months. That is from 1st February to December. So we multiply the $50,000 by 11. We can also do same alternatively by dividing 11 by 12 and multiply by the total profits. Okay. Let's take a look at other issues. We'll first deal with coterminous year end. The individual financial statements of both the parent and the subsidiary used in the preparation of the consolidated statement of financial position are to be drawn up to the same date or the same year end. Okay. So if they differ, the subsidiary is supposed to adjust its account to suit that of the parent where possible. In a situation where it is impracticable, adjustment must be made for the effect of significant transactions or events between the year-end date of the parent and that of the subsidiary, provided the difference is not more than 3 months. Let's look at uniform accounting policies. The consolidated statement of financial position should be prepared using uniform accounting policies for like transactions and other events in similar circumstances. If the policies differ, the subsidiary must adopt that of the parent to prepare the consolidated statement of financial position. If it is impracticable, there must be a disclosure together with the proportion of the items in the consolidated statement of financial position to which different accounting policies have been applied. Lastly, we'll talk about situations where non-consolidation can arise or exemptions to parent preparing a consolidated statement of financial position. So a parent is exempted from preparing consolidated statement of financial position if 1. The parent itself is 100% subsidiary to another entity. So secondly, the parent is not 100% subsidiary, but the other owners do not mind the parent not preparing group accounts or consolidated accounts. Thirdly, the parent's loans or shares are not traded in a public market. The next point is that the parent did not file its account with a stock exchange in order to issue shares. Okay. Then the ultimate parent of the parent already produces group accounts. Okay. That is when the parent is itself a subsidiary to another entity. If the subsidiary is held for sale, that is in accordance with IFRS 5. Okay, there's a video that we did on entities held for sale. So you can just click the link above and to be reconnected and get yourself abreast with the principles. Then lastly, if the subsidiary is operating under long-term restrictions such that the parent company cannot exercise control. Okay, people, this is where we bring our discussion to a close. I hope it went well. If you have any comment or feedback for us, do well to drop them in the comment section below and it will be timely and adequately addressed. Whilst at that, kindly subscribe and turn on all notifications. Also, follow us on our various social media handles as captured on the screen. Catch us again on another episode of Tutorials on the Go. Till then, take care of yourself and stay blessed. Poker.